Are you working to purchase your first home or maybe get back into a home after renting for a while due to some life changes? I utilized a down payment assistance program after my divorce to get my foot back into the door of home ownership. Maybe you're working on that and that's why you clicked on this video. So I'm so glad you're here. In today's video, we're going to be speaking with Sterling Campbell from Loan Depot about their new down payment assistance program. Not all down payment assistance programs are the same, so it's really important to kind of check out the different programs and see which one will best suit your needs. Now, there's pros and cons of down payment assistance programs, but they do work. I have utilized them, and they are a way to get our foot in the door. So stay tuned. Welcome, Sterling Campbell. Thank you so much for taking time to go over this loan program for the YouTube channel and kind of educate people on the opportunities that are out there to get your foot in the door of home ownership. How are you doing today?
Wonderful. And yourself?
Good, thank you. So tell us a little bit about who you are as a loan officer, why you choose to do this. I know for myself, it's about trying to get people in the door to home ownership, but how that changes our lives. So go ahead and tell us a little bit about who you are.
Great. Well, again, thank you for having me. I do greatly appreciate it. So I have been a mortgage loan officer for a little bit over 24 years. My company is the third largest lender in the country, direct lender, and we keep and service the majority of our loans in-house. But that gives us the ability to do things a lot of your mortgage brokers simply can't do. I think one of the neatest things that I enjoy is helping people, especially first timers, get into their house. For some families who have no one in their home has ever owned a home before, so it's really neat to be able to do that. But as you've discussed before, Laura, and much of your writing, so to speak, video and that type of thing, for the majority of middle class in this country, the majority of our wealth comes from home ownership. And something like, I think the numbers are 60 to 70%. So owning a home is truly an important thing, not only personally for your own financial growth and wealth, but also what it contributes to our societies. And I'm also a firm believer in really the best mortgage is no mortgage at all. But good for me. I'm in a business that most of us do need a mortgage to get started. But my ultimate goal is to get the people onto a path of being debt free, getting rid of all that miscellaneous debt, and then working on your mortgage. Because hopefully the goal that we can reach is when we do go into retirement, that we can be completely debt free.
Yeah, that's definitely something that we all strive for, and it does take work. It takes education. It takes being realistic with how we use our money and how we choose to place it wherever we place it. Definitely takes time. Well, let's talk about down payment assistance programs. There's pros and cons, but I always believe, and I always tell my clients that are first-time home buyers, real estate, it needs to be a long-term investment. It shouldn't be thought of as 1 to 2 years. It should be thought of more like 7 to 10 years, maybe short-term 5, depending on how the market is going in your area and the appreciations are moving. You might have the opportunity to step up and that becomes your first primary residence. However, let's talk a little bit about your Access Zero down payment assistance program so that they can learn a little bit more about this opportunity for them to try to get their foot in the door. So tell us about that.
Great. Well, we're sort of proud of this. We've only had this a couple of months now, and there's literally hundreds of down payment assistance programs nationwide, most of which we do have access to. But and they're all good, but they all have different limitations. Sometimes they're only for first timers. One of the nice things with our Access Zero program is it isn't simply for first time home buyers. And so basically how it works in conjunction with an FHA mortgage. So the standard requirement for an FHA mortgage is to have 3.5% down. So with the Access Zero program, we will provide a down payment assistance of up to 5% of the purchase price. So then you can use 3.5% for the required FHA down payment. The remaining 1.5% then can be used for closing costs. And as you know, Laura, especially in our area here, even though it's a seller's market, it is becoming a little bit more accommodating. We're starting to see sellers pay a little bit more of closing costs, sometimes repairs, so that, typically you can ask the seller to pay the remaining of your closing cost. So literally you may be able to get into a house with, a couple $1,000s out of pocket. So it can really open up some options for those people who don't necessarily have the down payment required for the particular program.
It's important to note, as a first-time home buyer, there are closing costs, and there are things like earnest money that you have to have up front. You have a home inspection, which can be anywhere from $400 to $650. So you do have to have some money in the bank, even though you're using a down payment assistance program. What I loved about what Sterling's program does is it offers enough for you to help offset the closing costs, because they can be 1.5% to 2% depending on the program that you're using, the home itself, a variety of different things. But not all of the down payment assistance programs offer that much. Now, obviously, there is a payback for that down payment. There's a variety of things, and one of them is called PMI. It's private mortgage insurance, and it is an additional payment on top of your principal, your interest, your taxes, your insurance, potentially even an HOA, and a PMI payment. So how do the PMI programs work with these down payment assistance programs? What should a buyer know about this?
Well, for this particular program, like I said, this is strictly for FHA, which is a federal government program designed more for first-time home buyers, but you don't necessarily have to be one. And so the minimum requirement is 3.5%. There's a different program sometimes we can use for conventional that only requires 3%, but right now, today, we're just talking about the FHA. Mortgage insurance is something that most individuals have to have if they have less than 20% to put down on the purchase of a home. Really, the main exception to that is for veterans, but everyone else has to. And basically what it is, it's an insurance policy for the mortgage investor that if you were to default, they could get some of their investment back. But it does allow the average homeowner to purchase a home without having to have that large down payment. Now, your mortgage insurance can vary, based upon, with FHA, it varies based upon how much you put down. And so it's literally a percentage of the loan amount. And with FHA, it's a little bit different too, in the fact that they charge not only a monthly mortgage insurance, but also a upfront mortgage insurance. Now, that is a percentage added to the loan. So most people don't realize it, but obviously you will be paying it over time. And so, again, a requirement to be able to have that reduced down payment. And again, just a percentage based upon how much you put down.
So tell them a little bit about what happens. Where does that down payment that they are achieving from the program, how do they pay it back? Where does it go? Is there something they need to know about that?
There is. What it is, you will actually have two mortgages on the property. The first mortgage, which is 97.5% of the purchase price, and then you have your second mortgage, which is the 3.5% to 5%, depending on a couple factors there. But let's say the 5% then becomes a second mortgage on the property that is fully amortizing. So it's amortized typically over a 30-year period, and the interest rate is typically 2 percentage points higher than whatever the going rate is on the FHA loan. And as you know, in today's world, interest rates are a little bit higher. Hopefully we'll be seeing them coming down at some point. But again, you do have those two payments. So you have your first mortgage, whatever the going rate is for FHA. The second mortgage will be the FHA interest rate plus 2%, but it is still a fixed mortgage. The mortgage itself, principal and interest, cannot change. Obviously, taxes and insurance can change over time there.
Yeah, I utilized another down payment program where it was a silent second. So there's a variety of programs out there. I would say I'd rather pay it down, as you are indicating this program does, because at some point you either refinance it, which then it comes all due and payable, or you would sell the house and of course it's due and payable then. So there's a variety of programs. Some work better for others than that, but all of them have a PMI somewhat associated with it. So,
Right.
why I said at the beginning, it's so important to understand that real estate is a long-term investment.
Pretty much whatever the standard FHA requirements are, we can apply those to the Access Zero program. There are no income limitations, number one. You can buy more than a single family unit. You could buy a 2 to 4 family unit as long as you reside in one unit. We can then use the rental income from the adjacent units to qualify. We can also look at sometimes a non-occupant co-borrower. Some people use this, a family member, to help them to purchase a home, whether it be helping them to qualify or maybe with closing costs, something along that lines. But again, it's pretty much standard FHA across the board. So it really does open up some options, because many of the down payment assistance programs, they're good programs, but they're usually run through nonprofits. And so there's a lot of, they may have many additional limitations that we do not see with the standard FHA program.
So are there income limits for the borrower, and what kind of credit score do they need to have to achieve this type of program?
Okay, so that's the really neat thing about this program: no income limitations. It doesn't matter how much money you make. There are credit score requirements. The minimum credit score requirement is 620 or 625. Please, not to double check on that. It's just a fairly new program, but around that range. With that, you can get up to 5% of the purchase price. So again, as we discussed, 3.5% for the down payment, 1.5% for your closing costs. 600 to the 625, then under the 625 down to the 600, the down payment assistance is only 3.5%. So you get the down payment, but then we have to deal with the closing costs. And again, closing costs can be paid by the seller. And in an FHA program will allow the seller to pay up to 4% of your purchase price in the way of closing costs. They can't do your down payment, but they can do closing costs. So even sometimes that could be used possibly to buy down an interest rate, to make that interest rate a little bit more workable for you, at least for a short time period there. Closing costs can also be paid, as I mentioned earlier. Standard FHA does allow a family member to gift the down payment closing, or excuse me, not the down payment, but the closing cost to you. And it does have to be a true gift.
Okay, so we've spoken about first-time home buyers, and that definition people often get confused about. So obviously a first-time home buyer literally could be someone who's never owned a house before, but it can also be someone who hasn't owned a house in a certain period of time. Can you define that a little bit better for the?
Absolutely. That's defined as having owned a home in the last 3 years. If you have not owned a home in 3 years or plus, you are considered a first-time home buyer. Again, for this particular program, not a requirement, but for some programs there are requirements, but typically then they'll have income limits. You can only make so much money, that kind of thing. So with this, it just opens up so many more possibilities for you.
Well, and I mentioned earlier, and I think maybe even in our previous video, it's important to note, if you are a first-time home buyer and you're looking at these programs, you still have to have some money in the bank. So purchasing a home, whether it be a VA or an FHA or anything, I think this is something that's really important to understand, is you still have to have earnest money. It's typically on average about 1% of the purchase price. You want to do a home inspection, and depending on your area and the type of inspection items that you want looked at, it could be anywhere from $400 to $650. You need to have that money up front. The earnest money is typically due 3 days after execution of contract, so that money should be there. But the loan programs themselves might also need something they call reserves in your bank account. So you would need to have some savings also, even though you're using a down payment assistance program. So are there additional things that they need to have in the bank for some of these programs, Sterling?
Well, the one thing that, and this is pretty much for all mortgages, you do have to have, once the home inspection is done and we get ready to order the appraisal is something that has to be paid for at the time of order, because appraisers are independent third parties. So once it's ordered, they do have to be paid. FHA mortgages right now, appraisals are $650. So that is something that we will charge to your credit card when you order it. But I strongly agree with what you're saying. Even if, some programs do require you have some cash reserves. I am a firm believer, like most good financial planners, that if you're employed, you should have 2 to 3 months of your monthly expenses set aside in an emergency reserve account. Life does happen. And even with a home inspection, sometimes a year or two later, again, those surprises can come home to roost there. If you're self-employed, you should then have 4 to 6 months of your monthly expenses set aside. Now, with the Access Zero program, typically if it's a single family property, there's usually not a requirement for maybe 1 month, 2 months of your principal, interest, taxes, and insurance, just to have a little bit extra there. But when you do look at, say, a multiple unit property, if you would look at a 2 to 4 unit property that you will be residing in one unit, in those cases, they usually like to see at least 6 months of the principal, interest, taxes, insurance, mortgage insurance set aside in some type of account. Now, this could be checking, savings, but usually we can also look at investment funds, stock funds, bond funds, but also typically retirement funds too, such as IRA, 401k, that kind of thing. And not that we're going to be touching it, but again, the idea is you want to have financial reserves, because I can tell you, as a real estate investor myself, we learn the hard way sometimes that having a good financial reserve is a necessity. You just never know what's going to happen with tenants. They may decide to leave early and not make their rent. They may decide to do some damage on the way out. You need to be prepared for those type of situations.
Yeah, completely agree. I also feel sometimes we are in a high military area. We have 5 military installations. So Sterling himself is a veteran, and I work with a lot of military. And it's often you'll own a property, and like I said, it should be a long-term investment, but sometimes the government owns you and they tell you got to go somewhere else sooner than you thought. And it becomes an investment property, even if it was your primary residence or you bought a 2 to 4 unit and you have those renters. The value of a property manager is just so incredibly important if you are not in the state or in the area and able to support a property manager. So I did do a video, and I'll link it up there on the value of a property manager.
Yeah, and one other thing to keep in mind too, for the multiple units, again, you want to have a little bit more reserve. But typically they are going to require, if you do not have experience in managing rental properties in the past, typically they're going to require your first time out of the box that you have a property manager at least for a year or two. And really, if you don't have the experience in it, as Laura said, a good property manager can save you money. And you're not getting those telephone calls at 10 o'clock at night. Been there, done that. Yeah. So again, plan that in. Typically 10 to 12%, I believe, is what property management is running these days, of the rents. But typically a great investment, and especially if you're out of town.
Who's the best fit for this type of program, Sterling? Who do you see utilizing this? I know I use it in a divorce.
Yeah, first timers in general, but somebody who doesn't have a lot of financial reserves investment wise. Again, though, like any mortgage, any home purchase, sitting down with your lender, your loan officer, we're going to look at your entire financial situation, because for most people, I'm helping to create not only their largest debt, but their largest investment. And I look at that as a responsibility I have to help them manage that debt, that investment, not only now but for the long term. My clients are stuck with me for life. Hopefully that's a good thing. Most of them it is. But you have to look at your financial picture, because unfortunately, too many people look at a mortgage separate from the rest of their finances, and you simply can't. Your mortgage affects everything: your cash flow, your taxes, your investments or lack thereof, and even long-term, as we've talked about, factoring into retirement. So you really need to look at that entire picture.
The right time to buy is when you're ready, when you have the money in the bank, when you have the financial stability to be able to make that payment each month and you're comfortable. And when is the best time to meet with a loan officer? Anytime. It could be up to a year ahead of time, because you might have things to work on in your credit. So don't ever hesitate to reach out to a lender. There are a variety of programs that they have, and they can help guide you, inform you, give you information as to what they will need so that you can begin to set up and prepare yourself for that first home purchase. It's never too early to talk to a lender. So Sterling, how can they reach out to you? I will put his contact information in my description box below, but feel free to let them know how to reach out to you here in the video.
Great. Well, again, Sterling Campbell, Loan Depot. My email address is S as in Sterling, Campbell. Campbell is like soup, C-A-M as in Mary, P as in Paul, B as in boy, E-L-L, at loandepot.com. So S Campbell at loandepot.com. Phone number 719-210-4353, or just type Sterling, Colorado mortgages, and you should be able to find me. I think I'm one of the few Sterlings in the state in the mortgage business.
Have to take those steps of reaching out to a lender. They are there to help you. They want you to get in a home just as much as you want to get in a home. But even if you get information from a lender, take a moment and go through your budget. You should have a budget. You should have a working budget that you know
Absolutely.
what you're spending every month. And is this comfortable? Can you afford the principal, interest, taxes, insurance, PMI, HOA, whatever it is that you're looking at, and make sure you're comfortable with it. Sterling may say, well, you qualify for this, but you get to make that decision as to what you are more comfortable in. And so you want to make sure that you're looking at your budget, that you're not just going, oh, he said I could spend this much, and then you get into it and you're uncomfortable. We don't want you to be unsuccessful. We want you to be comfortable in it so that you can enjoy the property and make it your own. So it's really important to do those steps and reach out to Sterling. He has got a variety of programs. As I said, I'll link a link to the property management video I did, but we also just did a video on home renovations. So he's got some loans for that too. So check out that video also. Thank you so much for watching and staying throughout the video. And thank you, Sterling, for taking time to educate us on the loan programs that you offer. And I'll see you on the next video. Have a great day, everyone.
Thanks for having me, Laura. Have a great day, everybody.